Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top business stories. COVID restrictions in January slow down India's economy further. In the Jan to March quarter, GDP growth at 4.1%, economy grows by 8.7% in 21-22. Core sector data shows a clear rebound in April. Good news for policymakers on the fiscal front. Deficit in 21-22 below expectation stands at 6.7% versus a revised budget estimate of 6.9% of GDP. Big fiscal bonanza for states. Central government clears all GST dues. Nearly 87,000 crore rupees disbursed. Question is whether the states will now reduce their taxes on petrol and diesel. Market snaps three-day winning run. Sensex falls 350 points. Nifty ends below 16,600. Financials, power stocks, top losers. Crude oil prices climb as European Union agrees to ban 90% of Russian crude oil import by the end of the year. The news of China getting ready to lift COVID restrictions in Shanghai and Beijing add to the rise. Traders expect China's reopening to add to oil demand. Monsoon likely to be normal this year. Met Department predicts La Nina conditions will improve rainfall over most of India. Huge relief for farmers and policymakers. If you were expecting clear signals about where the Indian economy is headed, the latest GDP figures are a mixed bag. The third wave of COVID really caused a break for the economy in the Jan to March quarter, slowing the GDP growth rate for a fourth straight month to 4.1%. The economy had grown by 1.6% in the same period last year. Meanwhile, the annual GDP growth in 21-22 rose to 8.7% versus a contraction of 6.6% in the COVID-hit 2020-21 period. Powering this charge was a 3% growth in the agri sector and a 9.9% growth in the manufacturing sector. The construction sector grew by 11.5%, financial services by 4.2%, and trade and other services by 11.1%. There was meanwhile some good news, with the 8 infrastructure sectors rebounding in April to 8.4% growth versus 4.9% in March. Joining us on the show, Madhvi Arora, lead economist at MK Global Financial Services, and Prasenjit Basu, chief economist at ICICI Securities, to discuss these headline numbers. Madhvi, let me start off with you. Did they meet the estimates you had in mind? Were you disappointed with either of the headline figures?
No, I think the numbers was largely in line with our expectations. We were looking at close to around 3.9% on the fourth quarter, as against 4.1%, which was expected by the implied numbers of CSO. So I think to a large extent it was in line. On the production side, of course, we were seeing impact of Omicron-related curbs, which likely seems to have slowed the fourth quarter recovery, especially in the contact-sensitive, intensive services. Moreover, we also were seeing rising input costs, which would have probably added, further pressure on manufacturing growth, and that's why we saw a much lower manufacturing growth on a sequential basis. At the same time, the high base of last year also had weighed on the YOY growth numbers in fourth quarters, and we also see some revision in the early part of this year in terms of first quarter numbers. So I think on net basis, not much of a surprise in the fourth quarter. For the full year, we were expecting a revised number of 8.7%. So I think pretty much in line with our estimates as far as the FY22 numbers are concerned.
Okay. Prasenjit, what do these numbers really portray in terms of growth going forward, the kind of prospects we're looking at for the current year?
Well, I think the most heartening feature of the numbers is the pickup in fixed investment spending. Fixed investment spending grew in real terms at 5.1% in the latest quarter. Nominal growth was about 15%, over 15%. And that suggests that we are seeing an acceleration, a steady pickup in fixed investment spending. To our minds, that is really the likely story of what will drive India's growth in the period ahead in the current fiscal year. I think also that India has been underestimating real GDP by quite a bit over the last 2 or 3 years, because there's a very wide gap between the balance of payments, current account balance, which is measurable and observable. That is generally running at about just over 1% of GDP for the full fiscal year. But if you look at net exports, the nominal net exports of goods and services for the fiscal year, they're running closer to 3% of GDP. That is a very wide gap. And if you look at the real number, it's over 5.5% of GDP. Real is based on deflators of exports and imports, and it basically is saying that our export prices are rising much faster than our import prices, and so there's a very wide gap in real terms or in inflation adjusted terms between exports and imports. That is completely, it defies logic.
Yeah.
So in fact, not just this year, but for the last 2 years, I am estimating that that the official GDP numbers that are being put out by CSO are actually about 2.5 to 3 percentage points lower than they should be, because of errors in the net export count.
Interesting. Madhavi, would you concur? And, we did also see quite a significant impact of Omicron. If we were to say this is safely behind us, perhaps we could look at more improved growth going forward.
No, I think the demand slack have persisted. I mean, before COVID as well, we were supposedly subpar with regard to our, potential growth. And, at this point also, even though it has reached the pre-pandemic level, and still around 6-7% below the pre-COVID growth trend that we were seeing. Consumption remains stubbornly low, while the level of investment also is just about recovers to its pre-COVID level. So I think the divergence between languishing private demand and high core inflation has also been persistent for a very long time in the last 2.5, 3 years, which means that domestic supply chain disruptions in manufacturing and services, especially in the informal sector, haven't been repaired fully. So the GDP numbers that you are still seeing are not necessarily capturing the real picture as yet. And that said, even with the current 8.7 plus kind of a figure that you're getting on GDP, which is obviously on account of base effect as well, we are at this point in time still subpar, and we are still growing at least 6-7% below the pre-COVID growth trend. So I think it's not necessarily a very rosy picture. And, while we're comparing our growth numbers with the West as well, I think the kind of fiscal boost that those countries have gotten vis-a-vis emerging markets in general, the comparison is quite stark. And India wasn't fully growing in line with its potential in the pre-COVID as well. And currently, in fact, with the kind of, the deep-rooted impact that COVID probably would have left into emerging economies, which did not really see the kind of fiscal boost that the advanced economies had seen. I think, there could be a starring impact of that in labor markets, and which actually would probably show in the medium term in a more starking fashion. So I think we need to be a little cautious before, sort of rejoicing the India growth picture, which is much higher than the rest of the world.
Interesting. Prasenjit, talking about being cautious, inflation, given what we're seeing in crude prices, still continues to be a bit of a red flag. How worried are you about the rate of inflation?
Of course, the current rate of inflation is certainly a worry. And the hope is that oil prices don't stay this high for too much longer, partly because you'll get a supply response from alternative energy, as well as from some of the marginal sources of oil and gas, such as shale and tar sands in North America. So as that supply response comes through, I'd expect that Brent crude prices will moderate somewhat by about September, October, and beyond. But of course, currently, the very high crude oil prices and broader commodity prices, including edible oil prices, are a bit of a challenge for India in terms of the monetary policy response, and the fact that headline inflation is a lot higher than the inflation target. Now, I think it's also important, though, to be aware of some measurement problems that continue with this GDP number. For instance, it's reporting that the fourth quarter private consumption expenditure in India only grew about 1.8%, despite the fact that nominal growth in private consumption was closer to 13%. Now, now CPI inflation is currently a lot higher, but in that quarter, CPI inflation was just over 6%, and the private consumption deflator that is being used in India appears to be the WPI rather than the CPI, which is largely inappropriate. You should be using something closer to the CPI as the deflator for private consumption. And if that is the case, then private consumption will be a lot higher in terms of real growth than is being reported in these numbers. So I think there are measurement issues that continue to plague our statistical indicators, particularly GDP. Real GDP, I think, is being underestimated, and this continues to be the case in the current quarter. Now, of course, relative to the rest of the world, India is currently the fastest growing large economy, likely to stay that way this year, and that is something to be celebrated. But we are, as Madhavi correctly pointed out, we are needing to catch up because we've had about 2.5 to 3 years of subpar growth, and really growing 8.7% is not enough to make up for that period of subpar growth that we've had. So we need to continue to see rapid economic growth in the period ahead, and the fact that investment spending is picking up strongly is, to my mind, a very positive sign. And of course, in terms of exports, India has seen the fastest export growth of any country in the world over the last 16 or 17 months. In 2021, the calendar year, India's exports grew 41.6% in nominal terms, nominal US dollar terms. That is easily the fastest in the world. So we are benefiting from a global recovery, but in fact, our export sectors are gaining ground, gaining competitiveness, which is, these are the two positives. Exports and investment are beginning to turn around.
All right. Just to come back to inflation, and now that we're seeing the monsoons and the advent of the season as well, Madhavi, again, do you feel perhaps there might be some relief inside, given that the monsoons are expected to be on track? And could this also play a factor when it comes to growth as we progress through the year?
Yeah, to some extent, yes, because India on a net basis is a global agri commodity exporter, so that sort of at least gives us that kind of shield that we may not see as high a cereal inflation, and we have to again see how much of MSP increase the government actually gives, because that will be a big input in my forecast for food inflation in general. But I think overall for the year, we still are going to be seeing an inflation which will probably hover above 6.5%. So that would be, even after taking the recent measures that the government has announced, I think which would probably have a downside inflation impact of around 40-50 bips overall, including the second round impact. But I think you could still see inflation hovering at close to around 6.4-6.5% for the year, which I think could again worry the policymakers in general, because in the end, a very high inflation doesn't augur well for growth in the medium term, and thus could act as a restraint point as far as policy ambitions are concerned on increasing the growth picture beyond the trend growth of 6-7%.
Right. So if I had to pin you down for a year-end target, then Madhavi, what would be your GDP target for the year?
So we were looking at 7.3 before this print. I think that there could be a mild revision close to 7%. I'm not looking at a very high downward revision from my earlier forecast of 7.3 for FY23.
All right. And in one line, Prasenjit, from you as well, year-end forecast?
Yeah, my forecast for the current fiscal year, I think I'm likely to revise it upward. This year's number is a little bit lower than I would have expected. And I think there's a cushion in terms of net exports, both in nominal and real terms,
Okay.
because that is being underestimated. So I think growth will be about closer to 8.5% in the current fiscal year,
Okay.
with an acceleration thereafter, given that we
Amazing.
have an
Okay,
investment.
Madhavi is smiling because yes, it's always good to hear the positive numbers, but she's definitely playing a bit more cautious and a much more bullish view coming in there from Prasenjit. But that's the that's the headline number that we're looking at today. Both of you, thank you so much for your time and for really taking us through some of the factors at play and behind your reasoning for how this year is likely to pan out. Thanks so much for joining us. In a big move, the government has released the entire GST amount owed to states up to 31st of May, releasing an amount of 86,912 crore rupees. The centre said the decision was taken to assist states in managing their resources and ensuring their programs are carried out successfully. The balance is being released by the centre from its own resources pending collection of cess. The centre also expects GST collections for May to be robust and good as April. Karishma joining us with all of those numbers. Karishma?
Well, right, Centre has decided to release compensation cess until 31st May 2022. So post this, it is only 1 month's compensation cess fund that will go to states by Centre. They've released almost about rupees 86,000 crore, and this is coming despite Centre having lost a lot of revenue in past few months because of global factors. In fact, Centre has also mentioned that despite with only 25,000 crore in their fund, they've taken this decision to keep all the balances clear. Now, the other argument is that states have been persistently asking Finance Minister Nirmala Sitharaman to consider a period beyond 5 years, but looks like Centre is not much in favour of this and may not give an extension beyond June 30.
Markets end the month of May on a somber note. Benchmark indices snapped their 3-day winning streak ahead of the Q4 GDP data and amid tepid global mood. Sensex ending over 350 points lower, shutting shop at 55,566. Nifty down 76 points, ending at 16,584. In fact, the Nifty declined over 3% in May, posting the worst month since 2012, the worst May since 2012. While Nifty small cap fell over 10% this month, Nifty mid cap also ended with huge gashes, falling over 5% in May. In the sharp fall in markets, Kotak Mahindra Bank, Sun Pharma, HDFC, Reliance, Shree Cement, some of the top laggards. After reporting record profit, ONGC was the top Nifty gainer today. Other blue chip gainers include NTPC, M&M, Coal India and Tata Consumer. In other news from the corporate world, homegrown auto major Mahindra & Mahindra is on a roll after hitting a lifetime high yesterday. The stock today also rallied over 3% to scale the 1,000 rupee mark for the first time ever. This after the company reported a strong performance in the March quarter. IKEA will launch its first store in Bengaluru next month. Spread over 12 acres, the IKEA store will feature over 7,000 home furnishing products. Direct-to-customer brand Sugar Cosmetics has raised $50 million in Series D fundraise led by the Asia Fund of El Capitan. Altogether, the cosmetics brand has now raised $85.5 million. If you expected your FD rates to rise handsomely after RBI's repo rate hike, shed those hopes. While the pass-through to lending rates has been immediate, banks have been slow and stingy in hiking interest rates for their depositors, including the single most popular savings instrument, fixed deposits, which as per the latest data stood at 151 lakh crore rupees.
They may be the most popular investment option in the country, but fixed or time deposits are not giving the best return. In fact, with inflation at near 8%, investing in FDs will get you a negative return, means you lose money at the end of the year. Interest rates are the lowest in several years and are likely to remain so in coming months, despite the Reserve Bank of India turning hawkish and increasing its repo rate and promising that more was to come. While banks immediately passed on the higher rates to their loan customers, the pass-on of the benefit to those with FDs have been slower and minimal. The State Bank of India has not hiked its rate for FDs below 2 crore rupees, while increasing loan rates by 20 basis points. ICICI Bank has raised FD rates by up to 20 basis points while jacking up its MCLR by double the amount. The HDFC Duo has also hiked FD rates by up to 20 basis point and MCLR by 30 BPS.
Hardly about 50-60% of that over a period of time you will see been passed on the deposit side. So what deposit rates today you're looking at about an average about 5.5-6%, will move to about 7% is what our estimate is in the next maybe 12 to 18 months, depending on when these rates comes into picture.
What most banks have done is to hike the rates on long-term FDs, those of tenure 3 years or more, and on bulk deposits. These comprise deposits of 2 crore rupees or more. The reluctance to increase deposit rates stems from the fact that there is enough liquidity in the market and banks have enough money to meet their needs.
Fixed deposit rates might witness some kind of an increase. But yes, of course, again, much of it will depend upon the excess liquidity which is there in the system, and which again is a function of the kind of credit demand which will be seen going forward.
Depositors can, however, take some comfort in the fact that with RBI sets to raise interest rates by nearly 1.5% in the coming months, they will profit both from falling inflation and increasing deposit rates. Bureau Report, Business Today Television.
India's $100 billion trucking industry is largely unorganized and fragmented, with truckers facing difficulties in being cost efficient. Raho, an on-demand intercity trucking management company, is developing a strong marketplace for connecting shippers and truckers digitally. The company has witnessed 6 times growth in the last 10 months. Business Today TV's associate editor Chetan Bhutani caught up with Imtiaz, director and CEO at Raho. Here's an excerpt of that conversation.
Thank you, Imtiaz, for speaking to us. Tell us what's Raho. I mean, what do you guys do? What are you planning to revolutionize in the country?
What we do as Raho is that we are trying to become a digital freight broker to make sure that a broker today is just as matching, but an offline matching, right? What we are doing is doing a digital matching. So look at Raho as somebody who connects somebody who wants a load to somebody who wants a truck in a more digital way by using technology and data science, so that the matching is perfect, so that where the trucker is standing, we're able to give him a load where he is standing, from where he's standing to where he actually wants to go, rather than making him go here and there.
So basically you're trying to say that if I have to transport my goods from supposedly anything, from one city to the other city, from Delhi to Chennai for example, I can come to your app or your website, I can book a truck, and I don't have to do anything except the formalities for filling documents, right?
Yeah, so if you want to move goods and you are a shipper for us, right? So you download a shipper app and you say, I want to move from, let's say, Delhi to Chennai. This automatically goes to a relevant truck owner whose truck is somewhere in Delhi and wants to go to Chennai. So from our system, we actually are able to match which truck should be attached for this particular load based on the origin destination, based on the type of goods, and most importantly, in this business, it's not. Today, what a broker does is that if the truck is standing in Manesar and the load is required from Noida, he will send the truck from Manesar to Noida. Whereas at the same time, there's another broker who's sending a truck from Noida to Manesar. This is, in our parlance, we call it a dead mile or a wasted travel, right? Our job is that you don't look at NCR as NCR. We look at Manesar, we look at Daruera, we look at Bilaspur, we look at Mahipalpur, we look at, let's say, Sonipet as different. Whereas, in a traditional offline method, he would look at, okay, Delhi se gaadi chahiye, he would move from a Manesar to Noida. So today we give it to the relevant truck owner, jiski gaadi wahan khadi hai, where the truck is standing. Now, how do we get where the truck is standing is through our driver app.
And that's all the time we have on the show tonight. Thanks so much for watching.